Active versus passive investing. Whenever there's a discussion about active or passive investing, it can pretty quickly turn into a heated debate because investors and wealth managers tend to strongly favor one strategy over the other. While passive investing is more popular amongst investors, there are arguments made of the benefits of active investing as well. Here are a few key factors to know before we jump into it. Active investing requires a hands-on approach, typically by a portfolio manager or another so-called active participant. Passive investing involves less buying and selling and often results in investors buying index funds or other mutual funds. Although both styles of investing are beneficial, passive investments have garnered more investment flows than active investments. Historically, passive investments have earned more money than active investments. Active investing has become more popular than it has been in several years. Active investing, as its name implies, takes on a hands-on approach and requires that someone acts in a role of a portfolio manager. The goal of active money management is to beat the stock market's average returns and take full advantage of short-term price fluctuations. It involves a much deeper analysis and an expertise to know when to pivot in or out of particular stocks, bonds, or any assets. A portfolio manager usually oversees a team of analysts who look at qualitative and quantitative factors, then gaze into their crystal ball to try to determine where and when that price will change. Active investing requires confidence that whoever is investing in the portfolio will know exactly what time to buy and what time to sell. Successful active investment management requires being right more often than wrong. Passive investing. If you're a passive investor, you invest for the long haul. Passive investors limit the amount of buying and selling within their portfolios, making this a very cost-effective way to invest. The strategy requires a buy and hold mentality. That means resisting the temptations to react or anticipate the stock market every next move. The prime example of a passive investing approach is to buy an index fund that follows one of the major indices, such as the S&P 500 or the Dow Jones Industrial Average. Whenever these indices switch up their holdings, the index funds that follow them automatically switch up their holdings by selling the stock that's leaving and buying the stock that's becoming a part of the index. This is why it's such a big deal when a company becomes big enough to be included in one of the major indices. It guarantees that the stock will become a core holding in thousands of major funds. When you own tiny pieces of thousands of stocks, you earn your returns simply by participating in the upward trajectory of corporate profits over time via the overall stock market. Successful passive investors keep the eye on the prize and ignore the short-term setbacks and even sharp downturns. Here are a few key differences. Passive investing advantages. Some of the key benefits of passive investing are ultra low fees. There's nobody picking stocks, so oversight is much less expensive. Passive funds simply follow the index they use as their benchmark. Transparency. It's always clear which assets are in the index fund. Tax efficiency. Their buy and hold strategy doesn't typically result in massive capital gains taxes for the year. Passive investing disadvantages. Proponents of active investing would say that the passive strategies have these weaknesses. Too limited. Passive funds are limited to a specific index or predetermined set of investments with little to no variance. Thus, investors are locked into those holdings no matter what happens in the market. Small returns. By definition, passive funds will pretty much never beat the market, even during times of turmoil, as their core holdings are locked in to track the market. Sometimes a passive fund may beat the market by a little, but it will never post big returns active managers crave unless the market itself booms. Active managers, on the other hand, can bring bigger rewards, although those rewards come with a greater risk as well. Active investing advantages. Advantages to active investing are flexibility. Active managers aren't required to follow any specific index. They can buy those diamonds in the rough stocks they believe they've found. Hedging. Active managers can also hedge their bets by using various techniques such as short sales or put options, and they are able to exit specific stocks or sectors when the risk becomes too big. Passive managers are stuck with the stock the index tracking holds, regardless of how they're performing. Tax management. Even though this strategy could trigger a capital gains tax, advisors can tailor tax management strategies to individual investors, such as by selling investments that are losing money to offset the taxes on the big winners. Active investing disadvantages, but active strategies have these shortcomings. Very expensive. The average expense ratio is pegged at 1.4% for an actively managed equity fund, compared to the 0.6% for the average passive equity fund. Fees are higher because all the active buying and selling triggers transaction costs, not to mention that you are paying the salaries of the analyst team researching equity picks. All those fees over decades of investing can kill returns. Active risk. Active managers are free to buy an investment they think would bring great returns, which is great when the analysts are right, but terrible when they're wrong. So which of these strategies makes investors more money? You'd think a professional money manager capabilities would trump a basic index fund, but they don't. If we look at superficial performance results, passive investing works best for most investors. Study after study over decades show disappointing results for active managers. All this evidence that passive beats active investing may be oversimplified. However, because active and passive strategies are just two sides of the same coin, both exist for a reason, and many pros blend these strategies. A great example is the hedge fund industry. Hedge fund managers are known for their intense sensitivity to the slightest change in an asset price. Typically, hedge funds avoid mainstream investments, yet these are some of the hedge fund managers actually invest about $50 billion into index funds in 2017, according to the research firm Symmetric. 10 years ago, hedge funds only held $12 billion in passive funds. Clearly, there are some good reasons why even the most aggressive active asset managers opt to use these passive investments. However, reports have suggested that during the market upheavals, such as the end of 2019 for example, actively managed exchange-traded funds ETFs have performed well, whilst passive still dominated overall due to lower fees. Investors are showing that they're willing to put up higher fees in exchange for the expertise of an active manager to help guide them and amid all the volatility or wild market price fluctuations. Active versus passive investing example. Many investment advisors believe the best strategy is a blend of active and passive styles. For example, Dan Johnson is a fee-only advisor in Ohio. His clients tend to want to avoid the wild swings in the stock prices, and they seem ideally suited for index funds. He favors passive investing, but explains the passive versus active management doesn't have to be either-or choice for advisors. Combining the two can further diversify a portfolio and actually help manage overall risk. He says, for clients who have large cash positions, he actively looks for opportunities to invest in ETFs just after the market has pulled back. For retired clients who care more about income, he actively chooses specific stocks for dividend growth, while still maintaining a buy and hold mentality. Dividends are cash payments from companies to investors as a reward for owning the stock. Andrew Negrelli, a Boston area wealth advisor and manager, agrees he takes a goals-based approach to financial planning. He mainly relies on long-term passive investment index strategies rather than picking individual stocks and strongly advocates passive investing. Yet he also believes that it just isn't the returns that matter, but risk adjustment returns. A risk-adjusted return represents the profit from an investment, whilst considering the level of risk that was taken to achieve that return. Controlling the amount of money that goes into certain sectors or even specific companies when conditions are changing quickly can actually protect the client. For most people, there's a time and place for both active and passive investing over a lifetime of saving and major milestones like retirement. More advisors wind up choosing a combination of two strategies, despite the grief the two sides give each other over their strategies. At the end of the day, it is up to you as an investor to do your own research and decide what style you want to adapt and use for your portfolio. Hopefully this video helped explain both investment styles, how they work, and what you can expect. Leave your thoughts in the comments and subscribe to Business Ventures for more weekly business and finance content.